In this week's video, we'll review a tremendous amount of present-day and historical data to help us answer the question, do the facts align with the bearish outlook for stocks and the economy? We have a lot to cover, so we'll be moving quickly this week. Feel free to use your pause button if needed. Yield curve, as we've covered numerous times, including on May 31st of this year, the long end of the curve, the 10-2, has not inverted, and 10-2 yield curve inversion is not imminent. On Monday of this week, the curve printed a higher high and has been making a series of higher highs and higher lows. Some things to think about as we move forward. The yield curve is more helpful relative to the market's expectations regarding interest rates. Credit markets, financial conditions, and spreads are more helpful relative to the market's expectations regarding future economic outcomes. The 10-2 yield curve is based on the yield of a 10-year U.S. Treasury relative to the yield on a 2-year government bond. Given the fact that U.S. government bonds are backed by the full faith and credit of the U.S. government, for the most part, the yield curve does not reflect default risk. Hence, it's less effective relative to expectations regarding the probability of default. The credit markets, financial conditions, and spreads are much better on that end of the spectrum. Both are helpful, but economically, the credit markets tend to be more helpful than the yield curve, especially the short end of the curve. We'll open the video with a detailed examination of present-day financial conditions. The concepts that we'll be covering are very, very similar to the concepts that we covered in last week's video. We'll be examining the Chicago Fed's National Financial Conditions Index. The Chicago Fed's National Financial Conditions Index provides a comprehensive weekly update on U.S. financial conditions in money markets, debt and equity markets, and the traditional and shadow banking systems. Positive values indicate financial conditions that are tighter than average. Think wide credit spreads, while negative values indicate financial conditions that are looser than average. Think tighter credit spreads. Ultimately, higher levels in the National Financial Conditions Index speak to lower confidence and lower trust. Lower values speak to higher confidence in future economic outcomes and higher trust relative to someone repaying their debts. This is the National Financial Conditions Index between 1972 and 1977. The shaded area here shows a recession in the United States, and if you know your market history, you know we had a horrible bear market in 1973 and 1974. You can see in early 1973 that national financial conditions began to deteriorate. Higher numbers are less favorable. And before we put the present day reading of the National Financial Conditions Index on this chart, keep in mind a higher figure would be less favorable, a lower figure would be more favorable. In late June 2019, we are on the lower end of the spectrum here. Black Monday occurred in October of 1987. These are the readings leading up to Black Monday. How does the present day compare? Present day readings are so low relative to the readings on your screen that they are literally off the chart. Keeping in mind that lower levels are more favorable and they reflect higher confidence in future economic outcomes, higher trust, and lower concerns relative to default rates in the bond market. In 1990, there was a recession in the shaded area here, spilled over into 1991, and the S&P 500 from a peak to a trough dropped 19.84%. These are the readings in the National Financial Conditions index in late 1989. How does the present day compare? Once again, we come in on the lower end of the scale. Now we're looking at 1994 to 2002. Shaded area indicates a recession in the United States. We have elevated levels in the National Financial Conditions Index starting in 1998 and carrying into 1999. How does the present day compare? Keeping in mind, higher readings are less favorable, lower readings are more favorable. Once again, if we place the present day reading on this chart, we would be on the lower end of the spectrum. Thus, you can make an argument that present day national financial conditions are more favorable and more conducive to doing business than at any time on this chart here, possibly with the exception of this period here on the far left side. How about the financial crisis? Recession and a bear market. We know the market peaked in late 2007. Once again, if we put the present day reading on this chart that spans from 2004 to 2009, it would be the lowest reading on this chart, or the least concerning reading on the chart. Same index, 2009 to 2014. If you know your market history, we had basically a bear market in 2011. The S&P 500 dropped 19.39%. For all intents and purposes, for the most part, that is a bear market. We have elevated readings here, 2010, 2009. And present day readings are more in line with the reading on the right side of this chart rather than the left side of the chart. These are the readings before the 19.39% drop. This is a good time to emphasize once again, we are using this hard data to monitor the present day risk-reward ratio of the financial markets and economy. We are not using this as a forecasting tool. In the real world, it usually takes time for credit conditions and financial conditions to deteriorate. Therefore, it might be helpful to know, how did the National Financial Conditions Index look right here at point A, after the peak, several months after the major peak, but before a 44% additional drop in the S&P 500? How did the National Financial Conditions Index look at this point A here before the 32.56% drop that occurred between point A and point B? What did the reading look like here before the 19.83% drop? If you know your market history, you know the S&P 500 peaked in March of 2000. What did the National Financial Conditions Index look like on April 13th, 2000? Keeping in mind that this is a weekly reading. It's only published once a week. After April 13th, the S&P 500 lost an additional 46%. How did our reading look here at this point A after the major peak, but before this 54% drop? And what can we learn from this similar situation here? Here's the major peak. This gives us a few weeks for financial conditions to deteriorate. What was the reading here before this 19% drop in the S&P 500? Here are the dates on the charts that we just covered. Here are the readings of the National Financial Conditions Index before the drop shown on the right side of the table. The moral of the story, the average reading in the National Financial Conditions Index before what turned out to be on average an additional loss of 36% in the S&P 500, the index stood at 0.31. The median reading hovering just under the zero line at negative 0.08. After we could see this reading here, the median reading The median decline was 38%, telling us in the present day, if we started to see readings like this or this, then our concerns would increase. Present day reading is negative 0.83. How long has it been since the National Financial Conditions Index was at 0.31? And how long has it been since it was at negative 0.08 or worse? The answer in both cases is a long time. The last time we had a reading worse than negative 0.08 was January 6, 2012. The last time we had a reading at 0.31, August 28, 2009. All of this tells us that financial conditions and confidence and trust in the present day are frankly much better than they were in the average and median case prior to a roughly 37% additional loss in the S&P 500. Is it possible that the National Financial Conditions Index will spike soon? We know the answer. It's absolutely positively yes. Therefore, like anything else, we have to keep an open mind about all outcomes. Right now, using this as a tool to monitor national financial conditions, things look pretty good, especially relative to concerning periods in the past. There's nothing magical about the National Financial Conditions Index, nor is it a perfect indicator to look at in isolation. The perfect indicator in isolation does not exist. It's simply one component of the weight of the evidence. Remember, we said lower readings in the National Financial Conditions Index speak to higher confidence and a higher trust. And higher confidence, higher trust, and lower rates tend to stimulate the economy. Yes, market participants have been buying bonds. All we hear about is how that's concerning. We hear very, very little about the stimulative effects of lower interest rates in the economy. This week, mortgage rates hit a 2.5-year low, stimulative. From a Bloomberg Twitter feed, supply is starting to follow the incredible demand for high-yield junk bonds. Junk bond issuance is on pace to be the most in 3 years. This stat here speaks to present-day perceptions about default risk and future economic outcomes. There's a lot of intelligent people on Wall Street working in high yield. When they start to get concerned, we won't see tweets like this. That concern could start tomorrow, but it hasn't started yet. Last week, we talked a lot about credit spreads. This week, credit spreads better, worse, or about the same? The answer, once again, is better. Spreads are narrowing. They are not widening. 4.05 is not particularly close to 5.97 or 5.75. Thus, we have now covered two forms of important and relevant fundamental data: credit spreads and the National Financial Conditions Index, neither of which are raising yellow flags or red flags at this time. How about straight technicals? Recently, the S&P 500's 100-day moving average, which can basically be treated the exact same way that we treat price. The only difference is it removes or filters out some of the volatility, and absolutely positively, yes, there are pros and cons to using moving averages. Like anything else, they are far from perfect. This look here is relatively rare. We basically just had a correction. This is a new high, a correction in the 100-day moving average for the S&P 500 that lasted roughly 8 months. As it turns out, that's relatively rare to have an intermediate term correction like this. Historically, This is not a particularly short whipsaw or blip on the radar relative to trends and the net aggregate opinion of all market participants. And it's not a devastating bear market that lasts 36 months. We went back to 1950 looking for similar intermediate term corrections in the 100-day moving average that were able to go on and print a new all-time high. We're looking for markets that were in a trend, corrected, and then resumed the existing long-term trend. 1952 to 1954, very, very similar situation, a correction in the S&P 500's 100-day moving average, and it goes on to print a new high. 1983 to 1985, we have a pullback and a new high. 1990 to 1991, similar to the present day, in a period that we've been talking about a lot in recent months. 1994 to 1995, we have a similar correction in the 100-day moving average, and then it goes on to resume the trend that was in place prior to the correction. Another period that we've been covering a lot in recent weeks, 2015, 2016, trend, correction, resumption of the trend. This is a breakout. Just like the stock market, when you make a new high, the correction is over. How many times have we had a similar intermediate term correction dating back to 1950? And what happened next after this point here, which is similar to this point here on June 27th, 2019? This is a very rare occurrence to get a 7 to 13 month correction in the S&P 500's 100-day moving average. There are other cases that are shorter. There are other cases that are more devastating and long-lasting. But these cases were the most similar to the present day. Looking out, 180, 365, 730, and 1095. 100% of the cases saw the S&P 500 move higher, and 2 years out, the median gain was 55%. Also noteworthy, in this window, 7 to 13 months, the present-day case is the shortest in duration. And in another example later in the video, we'll talk more about why this concept is important. Net bottom line here. This is another set of observable facts. We can't debate the fact that the 100-day moving average just made a new high after correcting for 7.9 months. Historically, when similar things happened, good things happened in the stock market, telling us to keep an open mind about better than expected outcomes. Also noteworthy, one of the most favorable cases on our list, 1995, a period that we've covered from numerous perspectives, including Fed policy and the yield curve. How concerning is it when small cap stocks lag the S&P 500? You can make your own determination how useful that is. S&P 500 from 1994 to 1999, over the exact same period, small cap stocks relative to the S&P 500. 1994, we could have said small caps have been underperforming. 1995, small caps have been underperforming. 1996, small caps have been underperforming. 1997, ditto. 1998, ditto. 1999, small caps have been underperforming. Well, let's assume that we decided to get out of the stock market in 1994 or 1995 because small caps have been underperforming. During that period where small caps were waving yellow flags about the economy and stock market, the S&P 500 gained roughly 215%. The NASDAQ gained over 400%. Small caps made money, but they lagged significantly, posting a 95% gain. This is the way we always look at things at Shivako Capital. If there is an indicator that could help screw up a 200% plus gain in the S&P 500, or help us somewhat miss a 400% gain in the NASDAQ, it is not an indicator that we are even remotely interested in looking at and talking about. There are much, much better things to track the risk-reward ratio of the S&P 500. As it turns out, over the same period, transports also could have helped us screw up the eye-popping gain in the S&P 500 and NASDAQ. 1994, transports relative to the S&P 500 have been underperforming. 95, they're underperforming. You better be careful. 1996, they're underperforming. 1997, they're underperforming. 1998, they're underperforming. 1999, they're underperforming. Guess you could make an argument it was helpful in 1999, but not particularly helpful during a period where the S&P 500 gained over 200%. From the end of 1993 to the end of 1999, transports did make money. They were up roughly 69%, but they lagged significantly, and that's what's shown on the bottom. This is the relative performance of transports versus the S&P 500. It's somewhat ironic in this business. When you get divergences, we read articles that it's bearish. When everything makes a new high in unison, we read articles that that's bearish because the correlations have broken down and investors are just indiscriminately throwing darts at the dartboard. Very, very difficult to understand how both of those could be bearish. What we want are indicators that have a high correlation to the S&P 500 and a consistently high correlation. For illustrative purposes, here's the correlation between SPY and the S&P 500, and it should, for the most part, be a straight line. The Dow, pretty good indicator, for the most part, stays above 0.5 and has a strong correlation to the S&P 500. If the Dow starts to get weak, that would be more concerning than small caps, bank stocks, or transports. Here's the correlation between small cap stocks and the S&P 500. Notice numerous times it drops below 0.5, and we even get periods with negative correlations to the market. It gets even worse when we look at the bank index. Here, a lot of negative correlations telling us it is not unusual for the S&P 500 to zig and to have bank stocks zag. Compare and contrast the correlation with the Dow. Up in the upper half of our correlation chart, quite a bit different than the look of the transports relative to the S&P 500. NYSE Composite Weekly, June 26, 2019, still holding this long-term breakout. How concerning is it that the NYSE Composite has not made a new high? It's not particularly unusual for the broader market to lag. Early 2012, S&P 500 daily prints a new high. Not yet on the NYSE. 2016, S&P 500 prints a new high, not yet on the lagging NYSE. You can see here, it really wasn't a major concern for the stock market, and we know from this point here, it really wasn't a major concern for the stock market. If a divergence like this persists for a longer period of time, the longer it persists, the more concerning it would become. But it's never particularly concerning for markets or ETFs or indexes that have very variable and inconsistent correlations relative to the S&P 500. The higher and more consistent the correlation, the more concerning a lengthy divergence becomes. We look at the stock bond chart dating back to 1979. We have a long period of sideways consolidation, a bullish breakout, and consolidation above the blue line, telling us to keep an open mind about stocks outperforming bonds for a long period of time. And notice, there are also intermediate periods of time between point A and point B where bonds significantly outperform stocks. This is a counter trend move within the context of a bullish trend. A chart here dated June 25th, 2019. German 10-year bond yields reach a new record low yield. We could have said the same thing in June of 2016. What is the message being sent by the bond market? What is the message being sent by the bond market? You'll notice these headlines are very, very similar. This one's dated June 12th, 2019. This one is dated June 14th, 2016. What is the message being sent by the German bond market? Here's June 14th, 2016. After this point here, after a big rush into bonds, stocks significantly outperformed bonds. Looking at performance in a little bit more detail, technology ETF, here's your return. Triple Qs, here's your return. S&P 500, here's your return after this headline. Here are bonds lagging significantly, AGG, IEF, and TLT, simply telling us to keep an open mind about better than expected outcomes in the stock market relative to the bond market. Doesn't necessarily mean bonds are going to get hammered. We're talking about relative performance. As it turns out, this headline was pretty helpful. June 22nd, 2016 talks about risk in the bond market. Well, from this point down here, it turned out to be a big underperformance risk. These concepts here also align with other facts from the present day. You can find this short takes post dated June 4th, 2019 by Googling this title here. The very, very rare setup on May 31st on the chart of TLT daily, weekly, and monthly thus far has been helpful. These are monthly stock bond charts. This is the Vanguard 500 index fund relative to the Vanguard Total Bond Market Fund. Think of this as SPY relative to AGG in the ETF world. February 1st, 2012. Tight look on our moving averages. Similar look on May 20th, 2016. It turns out we have a similar look in the present day on June 26, 2019. You can make an argument that this is possibly the more attractive setup relative to these setups. Why? We have a very, very tight look on our moving averages here for 6 months. Really only about 3 months here, 5 months here, but this is a much, much tighter and indecisive look. This type of look can be followed by very, very big moves. And if we zoom in on these three charts, you can also make a case that June 26th is more favorable than May 20th, 2016, and more constructive relative to February 1st, 2012. How can we say that? You can see here the 8-month exponential moving average in blue never really crosses below the 9-month exponential moving average. Not the case here. Bearish cross, have to recover. Weak enough to get a bearish cross here in 2016, have to cover. This is telling us that this trend at this point appears to be more stable in favor of stocks relative to this point here and this point here. If we believe that February 1st, May 20th, and June 26th in 2012, 2016, and 2019 are similar periods, then it might be helpful to know what happened next in the stock and bond markets from this type of setup. The answer is stocks significantly outperformed bonds. S&P 500 index fund up 44%. Aggregate bond fund almost flat. TLT actually lost money between May 20th, 2016 and January 26, 2018. Over the same period, the triple Qs made over 60%. In the 2012 case, S&P 500 Index Fund, 70% plus gain. SPY, 70% plus gain. Aggregate basket of bonds, diversified, roughly a 7% gain. TLT did make money and did print higher highs, but it only gained 11% in a period where the triple Qs gained 88%. Simply telling us to keep an open mind about much better than expected outcomes in the stock market relative to the bond market. Is it possible that this type of look resolves itself in favor of bonds and does so in a very, very significant way? The answer is absolutely positively yes. Until we see resolution, we have to keep an open mind about all outcomes. However, the weight of the evidence that we have in hand today leans more toward an outcome where stocks outperform bonds. All of that is to be determined. If you like visuals, what happened in terms of the look of this chart and this chart if we walked forward? You can see the same thing that we just saw in the table. The trend clearly favored stocks over bonds. A strong trend clearly favored stocks over bonds. 2019 to be determined. You also may have heard that we should be concerned because defensive assets are leading in the present day. If we take a closer look, is that really the case? What we really care about is performance since the December 2018 low. Why? Well, it's obvious before the low that defensive assets were doing well. What we care about is from the date of the low to the present day, are defensive assets or growth-oriented assets leading? And the answer is unequivocally that the present-day rally is being led by technology in the S&P 500, more defensive ETFs, REITs, utilities, treasuries, long-term TLT, gold, GLD, and IEF, all laggards, big laggards. This is the performance of VGT since the low. Here's the performance of IEF, GLD, TLT, XLU, and IYR over the same period. All of them underperforming SPY, QQQ, RYT, the equal weight tech, and VGT, the Vanguard Technology ETF. Telling us that we have to be very, very careful about making an assumption that something that's making a new all-time high is the best place to be. And between December 24th of last year and June 27th, it's very, very difficult to make the argument that the current rally is being led by defensive assets. This is not meant to be a negative commentary on any of these ETFs. We're simply presenting facts. And while we're covering these topics, if you sense a little frustration in my voice, it's because these topics come up over and over and over again over the years. And every time that we check present-day correlations and historical performance, we basically draw the same conclusions. The fact that these correlations are all over the place can give the impression that tracking the transports, bank stocks, or small caps is incredibly helpful. How can that be? Well, there are points in history where it appears to be incredibly helpful. That's why consistency matters. The more this looks like a seismograph for the big one, the more false signals that you're going to get over time. False signals can be extremely frustrating. This is being recorded on Friday, June 28th, and on Friday, June 28th, this will go into the history books. The S&P 500's 30-week moving average, after dropping below the simple 40-week moving average, has recaptured it. And this white space in here, or the period where the 30 is below the 40, spans somewhere between 100 days and 500 days. And as it turns out, dating back to 1950, There's only 15 cases that can check those boxes. 1 year later, 100% of the cases were positive. 2 years, 93%. 3 years, 87%. 93 and 93 at 4 and 5. The average gain 2 years out, roughly 29%. 3 years out, roughly 40%. Once again, simply telling us to keep an open mind about better than expected outcomes. And you can make an argument that numbers looking out 2 to 5 years for the most part typically always look good. That's true. One of the reasons why we're showing it is it's important to know that. Because for the most part, patience and holding periods are rewarded over the long haul in the stock market. Something like this, statistically, obviously not earth-shattering, but it's possible the occurrence improves the odds a little bit, and odds that are already favorable on average from a long-term perspective. The duration of these moves is important. If the 30-week moving average only closed below the 40 for 1 week, from a psychological and fundamental perspective, and a trend perspective, and a money movement perspective, and capital shift perspective, a 1-week drop really doesn't look anything like what just happened. Finding similar intermediate term shifts, which are quite a bit different than a 30-day shift or a 1,000-day shift, it speaks to the magnitude of the deterioration in the fundamentals, the perception of the fundamentals, and investor psychology. The shorter the duration, the less the concern, and the less damage that needs to be repaired to investor psychology. If it's a really, really long duration, it typically takes a very long time for investor psychology to turn. Thus, matching up the periods is helpful from both a psychological and fundamental perspective. The same thing can be said for this study. There's a reason why we match up and throw out the very short cases and the very long-term cases. You can make an argument. What this shows is the Fed made a mistake. If the Fed had handled the December 2018 meeting in a more effective fashion, it's possible that we would not have had a correction of this magnitude. How can we make that argument? Because as soon as the Fed changed course, the market changed course. You can hypothesize that the fundamentals, for the most part, were not the problem over here. And that's basically been backed up by economic data on the right side of this chart. The fundamentals over here told us that we most likely were not going into a recession. Well, now we're over here and we have not yet gone into a recession. The last GDP number that we got was over 3. It doesn't necessarily tell us anything about what's coming next, but the duration of this drop and the higher high here tells us we can hypothesize there was a problem over here and the problem was addressed. To give ourselves a little bit more of a visual as to why something like this might be relevant from a probability perspective. Now we're looking at the S&P 500 monthly with the 8-month exponential moving average in blue and the 9-month exponential moving average in red. You can see here, bullish look, blue above red, indecisive look. Blue in 1995, there's 1995 again, goes above red and we get a strong trend. Bearish cross in here, year 2000. For the most part, blue now stays below red. This really doesn't look anything like this. Bullish cross in 2003. This look here, for the most part, is similar to this look here. Far from perfect. Nothing is perfect. Simply helps with probabilities. 2007, we get a very, very similar look to this look here. And this period here looks similar to this period here. And this period here really doesn't look anything like this period here. 2009, bullish cross here, similar to this period here. So let's zoom in on the same 8-month exponential and 9-month exponential and look at some very, very concerning periods in stock market history. They all have something in common. Moving averages tend to roll over, and we tend to go from a blue on top to a blue on bottom look. This is the type of look that we would want to avoid in the present day. How does the exact same chart look today in June of 2019? Does it have a concerning look like this, or this? Or does it have a more constructive look like this period here, or this period here? The answer? Constructive. The same exponential moving averages just made a new all-time high, and blue is above red. Very, very difficult to make the argument on June 27th, 2019, that this here looks like this, or this. And we don't use something like this as a timing tool. It is more of a confirmation tool. If your shorter term signals are improving here, you would eventually expect to see blue get back above red. If your shorter term signals, your timing signals, are rolling over here, you would eventually expect blue to drop below red. And the present day chart aligns with what we're seeing on the shorter time frames. The shorter time frames started to improve here in early January of this year. We would expect to see this tight look morph into a more constructive and bullish look. And thus far, that's what's happened. Simply speaks to odds. Anything else on this chart? If we make it bigger and add in some lines, you can make an argument that this is the psychology of a cup and handle pattern with a bullish breakout here and the moving averages above the rim. The longer the breakout holds, the more meaningful it becomes. Anything else that tells us to keep an open mind about better than expected outcomes? Consolidation in the S&P 500. Harder markets are typically followed by easier markets. Easier markets typically followed by harder markets. Harder markets typically followed by easier markets, and eventually the market needs to consolidate its gains. The most attractive risk-reward point is here when you're on the top of this base because you have a reference point. Human beings tend to wait till we're out here to make decisions. This is really your best risk-reward entry point. It's possible that sometime over the next few months, because we may hang out near the top of this box for some time, even if we get a bullish resolution, it's possible that a very, very good risk-reward entry point is either here now or will form sometime in the next 8 to 10 weeks. That also falls into the to be determined category. If the breakout fails and we move back into the box, especially in a violent manner like this, then we'll also learn something from a bearish probability perspective. Market fractals tell us that this concept should also apply to a long-term quarterly chart. S&P 500, 1955. This is the 11-quarter simple moving average. Easier and stronger trending markets eventually need to consolidate their gains. Often, bullish breakouts are followed by stronger and easier markets. All good things must come to an end, and eventually the market needs to consolidate its gains. You can make an argument that this little blip here looks similar to this little blip here. After this little blip here, the S&P 500 rallied for 18 years. If we fast forward to the present day look more like this period here or this period here? The answer is simple. Here's the chart as of June 26, 2019. Common question might be, what about sample sizes? You can pause your video player to read this blurb here. In the short run, we have a big wild card in the form of trade relations with China, and often markets are volatile near periods where the Fed starts to change policy. And as we close, can't emphasize enough, we are not using any of this to forecast anything. If credit spreads start to widen, we will learn something. If the Chicago Fed National Financial Conditions Index starts to spike, then we will learn something about bearish probabilities. If this breakout fails, we will learn something. If this chart resolves itself clearly in favor of bonds, we will learn something. If this cross fails and is taken back, we will learn something. Thus, the only way that any of this works relative to our approach is to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.